traders, welcome to the channel. My name is Vicky GC, and on this channel I'm going to be teaching you guys how I analyze the market from the higher time frame using my SLK framework, how I get my directional bias. So that's the purpose of today's video. So first of all, I'm just going to talk about how I get my directional bias from the higher time frame, and basically I start from the weekly time frame. But first of all, we have to know what a bias is. What's directional bias? So directional bias is all about identifying the movement of price from point A to point B. So understanding the movement from a particular point in price, let's say this particular point, and understanding why price move from this particular point to this particular point. So that is just all about bias. So directional bias is all about identifying the price movement from a particular point to another. So simply, in other words, you're just looking for buy opportunities or sell opportunities, depends on your bias, right? So let's head over to the types of bias. So we have the structural bias in line with key levels, and we have the candle range bias. So first of all, let's talk about the structural bias. I hope by now a lot of traders know about market structure. So whether you're a beginner trader or an advanced trader, you still understand what I'm talking about. So let's say we have a market structure. So let's call this a trending market, which it is. So this is a trending market. Price is giving us a series of higher highs and higher lows at specific pricing levels. So we have higher highs at this point, and then price in turn comes to take out liquidity and break structure to the upside, because price basically does only two things: price balance imbalances at specific pricing levels, and then take out or attack the next liquidity. So price attacks this liquidity, comes back to balance imbalance at this specific pricing level, and then attacks the next liquidity. So that's just how price moves. So let's call it a trending market. So what do you expect in the trending market? You expect price to do what? Come back to fill up or balance and imbalance at specific levels, and then you look forward to buying opportunities to the upside. So this is for an uptrend, and also the reverse is the case for a downtrend. So a downtrend, you expect price to come back to fill up or balance imbalances at specific pricing levels at this point in price, and then you look forward your confirmation to sell to the downside. So this is just all about bias. So that's just how you get your structural bias. And okay, let's talk about also the candle range bias, but I will not explain that deeply. Candle range bias is just identifying with single candle formations, whereby you have a single candle formation which is called the candle range. People call it the CRT, candle range theory, or the PO3, whatever you know it as, whereby you expect price to take out the high of a candle coming from a specific pricing level. Price takes out the high or the low of a particular candlestick, and then you are to trade in line to target the next opposing liquidity at the other end of the candlestick. So this is just the CRT, how it forms. Expect price to take out the high, and then you are selling down to the low of the candlestick, which is what your draw on liquidity. That's your target. So that's just using specific candlesticks to get your bias. So but we explain this one deeply in the next video. So let's dive into structural bias. So first of all, I start off from the weekly time frame. Starting from the weekly time frame. All right, let me get this off. So we start off from the weekly time frame. So from the weekly time frame, you check for your market trend. That is what marking out your break of structures to the upside or break of structures to the downside, depending on the trend that you are in. So this is a break of structure to the upside. We have this. Price gives us a higher high, a higher low, and then price comes, takes out liquidity. It's called a liquidity run, and then price gives us a break of structure to the upside. So signifying that what the trend is bullish. So also at this specific price, we have another break of structure to the upside, signifying what that price is still bullish. So we are still going to the upside, and that's just how you frame your bias. So now we know that price has given us a break of structure to the upside. Now what do we want to do? We want to trade in line with it, right? We want to identify specific pricing levels that price might react from, and that's where key levels come in place. So now let's talk about key levels. So we have a support key level. we have resistance key level. Let me go over here. Right, so we have this as our, I mark this as resistance. So resistance, it forms as an E shape, right? So this is your resistance key level. I'll head over to the line chart to show you guys. So this is a resistance key level. Resistance key level, this is your support key level. Support key level for buys, resistance for sells. So this is a point where you have what, a support break to become resistance. When you have a support key level and then price disrespects it, and then what do you have in turn? Resistance. So you expect price to come back to it and then continue to sell. So also we have this one, resistance break to become support. So when you have a resistance key level, that's an A-shaped key level. Price disrespects it, what do you expect? Price to come back into it and buy to the upside. And also we have the QM, the Quasimodo key level. Also we have the QM, the Quasimodo key level. The Quasimodo key level forms after price disrespects a particular A-shape or V-shape key level more than one time. So let's say you have this particular key level and then price disrespects it for the first time, disrespects it here, breaks it. So you're expecting the support to break to become resistance, and then price disrespects it again. So this is now a QM, it becomes a stronger key level, and the reverse is the case for when you have a resistance key level, price breaks it for the second time, first time, second time, you expect price to come back to it and sell to the downside. So now I've been talking about directional bias, showing you the type of key levels. So now, why is directional bias important? Why do you need it? One of the biggest problems trader faces taking trades rather without knowing the market's direction. First of all, you need to know the market direction before you trade in line with the market direction, because you don't want to be on the wrong side of price. If you're on the wrong side of price, you get liquidated and then you end up blowing your account one day or another. So that's it. You need to know your directional bias before you now start taking your trades. So now let's head over back to the weekly time frame. Let's build a bias. So let's know, should we be looking for buys or should we be looking for sells? So I'll be working with the current price action. So at this particular point, like I said, this is a key level. Let me mark it out. This is a key level. At this point, this is a key level. You head over to your line chart to see it properly. So you can see it's a V-shaped key level. So this is a V-shaped key level. Price rejected from it, gave us a breakout or a break of structure to the upside. And then also this is another key level. We have this V-shaped key level. So this is the current one. Let's head over to our candlestick chart also. So we have this rejection. You can see how it supports price to the upside. So this is our first target. This is going to be our target rather, not first target. And also this is the point that price will break structure. So we already know that since price is bullish, we are going to be looking for key levels to buy to the upside. So that's just it. That's just how you build your bias. And then another thing you need to know is refining the key levels from higher time frame to a lower time frame. So this is your weekly key level. This is your weekly key level, and then you have to now refine from your weekly key level to your daily key level, because you do not expect to take your trade from the weekly key level. So after refining from the weekly key level to the daily key level, you also refine down to the 4 hours key level, the 4 hours time frame rather. So after refining to the 4 hours time frame, you can then, from the 4 hours time frame, whatever you are seeing on the 4 hour time frame, when the 4 hours is also in alignment with the daily time frame, you can then take your trade on the 1 hour time frame by refining 1 hour key level. So at this particular point, we had this is a daily key level at this point. Let me circle it. So this is a daily key level. We had a rejection at this point, price rejected from the daily key level. Let me cut this off, or rather let me cut it off. So we had a rejection from this particular key level. So that's the first step, marking out your key levels. Second step is waiting for a rejection and candle closure. So this is your rejection and candle closure. What do? You head over to the 4 hours time frame. the 4 hours time frame now will now give you an alignment. Let me use this trend line to separate it. So after the daily rejection, you head over to your 4 hours time frame. So on the 4 hours time frame, that's where you wait for your breakout or your break of structure. So at the 4 hours time frame, if you want to see your breakout, let's say you are starting out and you don't really know how to mark it out effectively with candlesticks, you can head over to your line charts to mark it out. So this is a breakout. So this is a breakout to the upside, right? This is a breakout to the upside. This is a breakout to the downside. So having known that we have a breakout to the upside, then mark out key levels that you expect price may react into. So you mark out our supports. This is our support key level. You mark out the QM. So this is the QM. So these are the key levels in discount. So what do you wait for? You wait for price to reject from them, and then you look for your confirmation. So you can see this is the key level. You can then wait for price to reject. So this is the rejection point. After price rejected from the key level, what do you expect? You head over to your 1 hour time frame. That's going to be your entry time frame. So what do you expect to see on the 1 hour time frame? You expect to see what? An engulf or what? Another breakout to the upside. So looking at this, this is the line that we are going to be taking our trade from. So first of all, we have this rejection. So as we mark out our key level, what we are going to be asking ourselves is, am I interested in buying or selling at this particular pricing level? So are you interested in buying or selling at this particular pricing level? So what you now have here will now determine. So there's no breakout on the 1 hour time frame, but there's an engulfing candle. There's an engulfing candlestick, this candlestick that engulfed. So you can then refine down to the 30 minutes time frame, because that's going to be your entry time frame. So in 30 minutes time frame, what do you expect? You expect price to give you a breakout. You head over to the line charts. So you can see a breakout. That means what? That daily time frame, the weekly time frame is aligning with the daily time frame, and the daily time frame also is alignment with the 4 hours time frame. And then the 30 minutes also, which is your entry time frame, is in alignment with the 4 hours time frame. So you can then enter off the key levels also. You have what? Your supports, you have your QM, or you can also enter from your resistance break to become support. So you can see this, a resistance key level that got broken to become support. We have also our QM, and then we now have our last resort, which is the apex. So this is our apex, the QM, and the resistance break to become support, RBS. So now you can enter as the RBS and let your stop loss cover the 3 key levels, or you can then enter at the QM, which is very advisable because the QM works a whole lot of the times. So you can use sorry, there's no shorts, we are going long, sorry. So you can then enter at your QM, place your stop loss below this apex. Let's head over back to the candlestick chart, and then you take your trade. So where will you target? You target 2 points. There are 2 points in price, possible reversal zones, possible reversal key levels, and then also you target your swing points. So for you to know your target, you head over back to the 4 hours time frame to know where you can possibly target. So the 4 hours time frame, there are possible targets. You have this is a key level, an E-shaped key level for sales. Also we have our swing high. We also have these key levels. You can then target key level to key level to key level to key level until all are being taken off, and then I have the swing points. You can then, let's head over back to our 30 minutes time frame. So since you already know our targets, you can then start taking your take profits. You can then start taking profits, and here give you a nice 1:7. And if you want to swing also, you can then swing to your high. But me, I'm not a swing trader, so I prefer just taking my profits at a possible reversal zone or the nearest target, and then that'll be all. So this is how you build your bias. And the next video, I'm going to be like building bias with the candle range, and I'm going to be going deep on it. And on the next video, I'm going to show you guys how I build my bias with CRT, the candle range theory, which is the second type of directional bias, which is the candle range bias. That one is also a high probability. I prefer that, and also this one, both of them works, but I prefer that because it gives you a particular point whereby you can exit rather than looking for possible reversal zone. So you know your drawn liquidity, and then you can just take your trade with confidence. I will see you guys on the next one. Vicky DT here. See you guys later.